I've had numerous messages from concerned expats regarding the new tax laws that come into effect this year. And on ASEAN Now, we've prepared a document to address some of these. And although it's not designed to replace any official communication, it is a simple guide just to at least put you on track and dismiss some of the rumours. I'm going to read through this document now and provide you a link as well on ASEAN Now, so you can go through these clear step-by-step guides. So it's a simple guide to personal income tax in Thailand, and this was prepared on the 8th of January this year. You may have heard that new tax laws came into effect on the 1st of January this year. In fact, that's not true. The old tax rule still exists and remains valid, albeit just one minor change to them was made in November last year. Previously, anyone who had earned money overseas and remitted it to Thailand in a different tax year received that money free of Thai tax. That loophole in the Revenue Department tax code has been extensively exploited by wealthy Thais and is now closed. Hence, any money earned overseas and remitted to Thailand in any year is now liable to Thai tax. The purpose of the new rule is to reduce tax avoidance. Unfortunately, it now means that overseas funds transfers by foreigners living in Thailand also have increased risk of being taxed. There are also certain types of visa that fall outside of the Revenue Department tax code. The long-term resident visa, for example, received its tax-exempt status by royal decree. Hence, visa holders will not be assessed for Thai tax, and they are specifically excluded from this explanation. During this, I will refer to the word accessible. Accessible in the context of this document and vlog means income that is liable to tax and must be included on a Thai tax return. Not all income is accessible, and you'll see how this differs as well between countries that I'll explain in a minute. And some is excluded from tax assessment by its very nature, or because of terms of a specific tax agreement, which America has. There's also dual tax agreements which come into effect. America of note stands out here. Now, if you stay in Thailand for more than a cumulative 180 days between the 1st of January and 31st of December each year, you will be considered to be a tax resident in Thailand during that year, regardless of what visa you have. It doesn't matter that you may be a tax resident in your home country or elsewhere you choose to pay your tax in. Thailand will still regard you as a tax resident. Tax residency and immigration status and the visa you hold are different things. Tax residency is based on solely the number of days you spend in Thailand and where you are at midnight on each day. Now, if you are a tax resident, therefore, you must review your income each year to determine if it's regarded as accessible to tax in Thailand, and nobody will do this for you. If your income does not exceed 120,000 Thai baht per year, you don't need to file a tax return. 60,000 baht if your only income is bank interest paid to you by the bank in Thailand. If your income is over 120,000 a year, you must file a Thai tax return between the 1st of January and 31st of March. Your income tax in Thailand is defined as money paid to you inside Thailand, as well as any money you receive from overseas. Both types are potentially accessible income for tax residents. Income that is derived from within Thailand is fairly clear. If you work, you have a job, you're a tax resident, your income is accessible for tax. Interest is paid to you on Thai bank account is regarded as income, as is income from investments such as stocks and bonds within Thailand. You should note that if you are generating income by work while staying in Thailand, it is and has always been irrelevant where the money is paid and whether you bring the money into the country or keep it offshore. That money arises in Thailand, hence is therefore taxable. Another common type of income, and one which most people are asking me about, is pensions. And this is where it can be complicated, unfortunately. It depends on the type of pension and the country that it comes from. The country of origin is important because there are over 60 different types of dual tax agreements, sometimes called double taxation agreements, between Thailand and those 60 plus countries, and each one is different. As a general rule, most private or company pensions from most countries appear to be accessible here, but you need to confirm that yours is or is not. If that is true, private and company pension income is accessible income in Thailand. US Social Security payments, a form of pension paid to some older people, can only be taxed by the US under the dual taxation rules, and Thailand is forbidden from taxing them. This means those payments are not accessible income. UK state pension, on the other hand, is not covered by the dual taxation agreement, so is accessible income in Thailand, whilst UK government or civil service pensions are not. It's not straightforward, is it? The proceeds from the sale of capital items such as overseas property, where funds are remitted to Thailand, is one popular source of funds. The sale of some investment products such as stocks, shares and bonds is another. Those proceeds typically comprise of two parts, capital and profit. If the capital was acquired before the 1st of January 2024, it is free of Thai tax. One way to separate capital and profit may be to have an official valuation or statement that is dated the 1st of January 2024, since anything earned before that date is not accessible. Also, if the profit has been subject of capital gains return in the home country, then may also be free of Thai tax, but it cannot be guaranteed at this time. Until things are more clear and once again subject to terms of the double taxation agreement, you need to review the double taxation agreement between Thailand and your home country to fully understand which particular clauses affect you. It appears, though, most property rental income that is remitted to Thailand is considered to be accessible income and is taxable here, unless of course it's been taxed in the home country and or the double taxation agreement prohibits its taxation, which does seem unlikely. You are responsible for determining if accessible income in Thailand exceeds the threshold, and it means you must file a tax return. That accessible income might compromise pension payments, investment income, rental income, or any other type of income listed in the links that on the ASEAN Now article on this. If you have accessible income of over 120,000 baht per year, you must file a tax return. Before you can file a tax return in Thailand, you need to acquire a tax identification number, TIN, from the Revenue Department office in your area. You'll need your passport, valid and current visa or extension, and in many areas a certificate of residency from the Immigration Department. Completing a tax return is a simple affair for most people. If you do have difficulty, the Revenue Department staff are extremely helpful. Tax returns must be filed between the 1st of January and the 30th of March each year. If you file later than that, then penalties will apply. I think that's really the headlines. The article is on ASEAN Now, and I'll add that to this vlog. I hope it's helped clear the mud a little bit more. This is only a guide. It's not designed to replace official government documents. Keep safe. Done about Thailand.